Priatelia, vítajte v podcaste, ktorý bude trošku špeciálny, iný ako všetky ostatné, pretože bude z veľmi veľkej časti po anglicky, takže upozorňujem dopredu, že to bude v angličtine, pretože tu máme dneska hosti zo zahraničia, aby ste videli nejaký rozdiel a v aj trhoch, aj v tom, ako vyzerá finančný sektor možno inde. Máme tu môjho co-hosta, Mateja Bajzika.
Zdravím vás všetkých, ahojte.
A ty prosím ťa predstav hosti. We will introduce you now.
OK. Tak začnem asi po slovensky najprv. Pozvali sme si bratov Schoberovcov, ktorí sú považovaní, alebo ide s nimi nálepka, že sú považovaní za najmladších portfólio manažerov v Európe. So I told that you have this special label. You are considered as the youngest portfolio managers in Europe. So let me introduce you brothers Schobers. Tobias and Jakob.
Hello, thanks a lot for being here in this podcast. It's actually our first Slovakian podcast, and we feel extremely honored to be here. And yes, as you said, youngest portfolio managers from Europe. I think this is a little bit too far, this wording, and we don't know if this is true, and we probably think it's not right. But it's true that especially Tobias is still pretty young. You are now
24.
I mean, it's difficult for me to remember because it changes every year. But
you are all right, that was funny. Nice. Starting with a joke, it's always good.
Yeah, actually, next week. Oh no,
who's younger?
Tobias.
Me, yeah.
Okay.
So in like 2 weeks, I will have my 25th birthday. Just for you to
for you to know. For you to know.
I expect a present.
How did you get to this job? It's really, first of all, how did you get to this job? And second of all, how is it possible that brothers cooperate together in this very specific field? I need to know the background story.
So, it actually all started by our father. We had the huge privilege that our father already started with investing about 20 years ago. We have a little wood manufacturing company, and I think it was about 2006 or 7. He had a really good timing because he invested before the financial crisis. So it's
very good timing.
Yeah, so the first years were super tough. And our father, as if you start investing, you get to know also the strategy of Warrena Buffetta and things like that. And my dad really liked that. And I mean, many people in Austria like to buy also real estate things and leave their money on the bank.
Yeah.
And
same as here.
Yeah, and he really enjoyed to be a business owner, to have a part of a business. And Tobias and me, we started, I think, about 10 years ago with like a family fund where we looked for things heavily influenced by our father, obviously.
How old were you?
I think I was 18 and you were 14.
I was, I think, 12 when we started the fund. It was a little earlier that we started the investing part. So I still remember very vividly those 2008 years. I actually loved those because I did not have that much money invested also. Yeah. And I had money on the bank account.
Wait, but you were invested in 2008.
Yeah, I got my first... so I was always doing like some labor.
So you were 9.
Yeah. Around that age, I was like mowing the grass, and I got like €4 or €3 in the beginning per hour, and I invested most of that cash that I received in Microsoft stock, and I held it until today, fortunately.
Okay. How?
Actually, it was always like we are 5 brothers.
All right.
So to answer your second question quickly, if you have 5 brothers, there is a chance to start the company with one of them. But we were always quite a sporty family also, you know, we liked to play soccer and stuff like that, and we enjoyed that a lot. And Tobias was also the one
I wasn't sporty. I'm still not sporty, unfortunately.
You're the analytical type, yeah.
Yeah, and he was always the one who was sitting on the sidelines and already reading annual reports. I guess you didn't understand anything back then, but at least he pretended, and he really liked the investing style. And from a young age,
it looked cool. I'm reading annual report.
Stop right here. How is it possible that how old were you when you were reading annual reports of Microsoft?
I don't know when I read the one from Microsoft, but like I started mostly with the Berkshire Hathaway annual letters because those are easier digestible. And so my father, also Andrei Kostolany's book, I think was my first one. I read it with 8, I think. I'm not sure. I didn't understand it, but I liked it.
Yeah.
I think I liked it. But
children remember a lot. A lot, like a sponge.
It is, but it's actually what was our big advantage, that we were put from our father and also our mother, obviously. We were put in this direction, and they somehow managed that we wanted ourselves as well. You know, that we were really, and then we were seeing it as a sport. We were already practicing when we were super young, and actually on our dinner table, we didn't talk a lot about what is going on in our village or who is the next major or the next chancellor of Austria or anything like that. I think it was most of the time it was economics, it was Buffett, it was investing, and with our dad, through our dad,
crazy.
we were learning it, and that's actually how we came to value investing. And
I actually think of my father now because I see what he did in hindsight now, as some master in psychology. Although he doesn't have any degree or so, and I always thought like he isn't, but like what he really also in that kind mastered, and maybe he had that from Dale Carnegie because he loved his book so much, is that he knows, for example, that in our family we are really eager to. If someone says a statement, we want to destroy it, whatever it is. So we just want to have a fight, and because we enjoy it so much. And our father, on purpose, I think,
a challenging discussion.
Yeah, he did like challenge us in a way by saying things that are like more or less right or more right or whatever. And then he started in us this fire to prove him wrong or right or whatever. And that's like the fire that is still lit today.
But as I understand it, he was not a financier.
No, he was a business owner.
Right.
And therefore he was a financier.
Yeah, sure, but that's not always like that.
Correct.
A lot of people are in business, are let's say self-made, but have no idea how to work with money.
Exactly. So if you put it in this frame, it was more like a capital allocator.
Yeah.
And financiers, you just said.
He understood the value of money.
Correct.
Yeah.
Yes, exactly. And then actually, so this was when we were super young, and then we won actually some stock picking games and got awarded with some cars.
All right.
Yeah, actually we today we won one half a year ago, and today we get delivered our Jaguar that we won in that game.
It was the 4th car you won?
Yeah.
That's crazy.
And this was our smallest brother now, Pauli, who won this car.
Yeah. He's really getting good. I mean, there is some teaching to be done, but he really
challenging, definitely.
But he really is able to kind of play those on his own. And actually, in another game, which is currently, so we are not talking about that so much, but he's quite on the upper side. Yeah. It's really good.
So you are basically going towards an actual family office.
Correct.
With all your brothers, or do you have some siblings that are not involved, definitely, or in some other business? As
we were as it was such a big topic in our education, I guess we are all heavily influenced by it. But as it looks now, Tobias and me, we are the only one who really are into the money managing area.
And a very deep analysis. So we like to talk about also sometimes politics and all that stuff, and but like this really thorough research, because we are doing like that value investing where we really dive into those companies. I think it really has to make a lot of fun for you, otherwise you are not doing it.
Well, since you were a child and reading annual reports of Berkshire, I guess
without
it's funny.
understanding.
I would say it's important to tell that the annual reports from Berkshire is not easy reading. So, like, head down, really.
Head down.
Yeah.
But only the German translations, of course. So the English ones I didn't read.
Anyway.
Still.
Okay, as far as I know, you're not living together. Like, I mean, not near together. How do you cooperate like this way when, if, as far as I know, one of you are on the one side of the country and the second one is on the other side of the country?
Really well said. And yes, it's actually a benefit we have as financial advisors. And if you look at or we're managing the family office, as you said. So our daily job is we are looking for opportunities in the market, right? As Tobias said, we are valuing companies. Tobias is more on the research side to really find out, because it sounds so easy how to value a company, but how you really value a company, this is actually the topic Tobias is really focused on. And all you need is a laptop, internet, and and basically you can do it from anywhere. So I'm located in Salzburg and Tobias is located in Vienna, but
most of my work days is just like going around in Vienna and like going into some direction and then just walking and thinking and trying to not get hit by a car.
Well, I think in Vienna is more. There is a more chance you get hit by a bike.
Yeah, actually, that's kind of true. Especially because if I feel they don't care so much, but it wouldn't hurt so much. So,
what is really important? Your head has to be okay. So probably you should walk with a helmet on.
Sounds like a good investment then.
So nevertheless, you guys run. Is it an official family office, or is it somewhere in between on a way to be a family office? Or what is your current state, so I can understand it?
It is just a wood manufacturing company, which consists of a financial arm, I would say.
Okay, yeah.
And then you can see it a little bit like a holding company.
Right.
Somehow.
Okay.
So we don't intend to be a real family office, because we have no advantages in Austria because of that, because as we're already a company. And what we are doing is basically if there is money from the wood manufacturing company, we take it and we try to allocate it. I mean, it also is an allocation if we buy a new truck, or if we expand the company, which we are not doing at the moment due to many reasons. But this is actually our job now, capital allocation within the company.
Yeah. That's really cool. And what are you focused on? Like when are you focused on a current or on a certain market, or all over?
What's your approach?
So it's really different for both of us, because what Jacob just said before, it's like I'm doing the research and he's like doing the valuations. And so my process really like very, very long term. And like the thing in economics is it's such a young science that most of the stuff that we think we know or like we don't know anything actually. It's like psychology is like a young science, but like economics is like way younger. Yeah. And so there is a lot of theories that you can uncover and that you can calculate and that can give you some edge. And I'm like really also in my mind there is like not that much structure. I'm just wandering around those theories, just what gets me now and what I like now. And Jacob, so I'm like, I think myself more as the chaotic type in the sense that I'm trying to like Schumpenberger or who Schumpeter. Yeah, he's like that destruction, and I'm like destroying always. Yeah. And Jacob is then ordering it again. And so I think his job is actually harder because I just do what I like. And he's trying to implement those theories then. I mean, that's quite abstract, maybe.
Yeah. What we are looking for is, as you already mentioned, value investing, heavily influenced by Buffett, as you could tell already with Tobias' experience with annual reports of Berkshire Hathaway. And what we are looking for is really companies where we get the most value for our money. And this, as I said before, this sounds simple, but
it always sounds simple.
It always sounds simple, but we really try to be to gain an edge in different things. So our market is because you asked, is, I would say, US focused, but it's not just US. So it could actually be anything. So it's still, we are still somehow on the like mega cap area. So I would say above $10 billion. This is actually the companies we are looking for, because you have much more data and much more informations. And we are, one could say, we're extremely lazy, because as I already said with the sporting analogy, we really think to be the best and to really have an advantage, we need to be also the best one in knowing the company and also with the numbers of the company.
Sure.
And therefore we think from ourselves we need to be in the top 1%, I would say. And that's why we are not able to analyze or buy many companies. For example, last year we just bought one stock. In 2022 we had a new record where we bought 3 different stocks.
Right.
But this is actually what we are doing. So we really, it takes, for us timing is almost not existent. To be really well informed about a company, we need about, I would say, at least 2 to 3 months.
And that's Jacob's work mostly, like this data gathering and like verification of that stuff. And like there's stuff that is wrong on Bloomberg, and when people use that, you have an edge.
But how do you know it's wrong?
You
need to look at it and you read the annual report
and then calculate yourself.
So you find the company.
He's actually finding.
You're doing.
I'm just doing the theories, because like the problem is, even if you have the data and even if you know the area and you know everything about all those companies, you know all the data and you know everything, a lot of people fail to put it into sound equations that don't need to be complex, but like you have this beautiful word in German where you.
It's for
this kind of relativity.
Yeah, for Verhältnismäßigkeit, the proportionality.
Yeah.
We say it's. I think everyone who is in a job knows that in his job there are some things that are extremely unproportional. For example, let's speak about bureaucracy. Yes, or like the law that you have to do, or like we as financial advisors have to take care of the things that our clients are, where they're making their cross and stuff like that. And the proportionality is sometimes not correct. And this is what we are looking for.
And that's like the mathematics that I try to put in, so that the proportionality overall is. So, for example, one company where that was really, that was a huge win. No companies.
No companies. No.
No companies.
No companies.
But sometimes, can I?
There are companies. I can put it easy.
You don't need to mention any companies.
Yeah, but for example, to put it maybe simple is, Buffett learned from his teacher, which was Benjamin Graham, and Benjamin Graham was able to find companies which had more cash on their balance sheet than they cost. This sounds also simple, but think invert, like Charlieho Mungera always says, just invert. It was so crazy that there were people who were selling their stock or who were selling their business, although they had more cash than the price they were giving. So this without that. So no one would sell that, right? But this was possible. And it's almost not possible anymore because of data, because of, as you said, Bloomberg or financial things. But there are things who are similar now to having like more cash than the market cap is, and you just need to find these things. And the calculation or the mathematics is more complicated, but not much more complicated.
Maybe to put it into very simple human language, is that the fundamental analysis is not enough, because many people who invest in stocks thinks that it is enough, to know what company is doing and so on, and bye-bye. But as you are saying, and as your approach is that one have to prove that in numbers, mathematically.
Correct. I mean, we all agree that Rolex produces amazing watches. But is it at the end of the day, how is the value to price? Is for a Rolex Submariner, I don't have a Rolex, but I'm just throwing around words and brands now. But is a Rolex Submariner, is it worth 6,000? Is it worth 12,000? Or is it worth 50,000? I mean, and to calculate these things and to really find out, is it a good value? Is it a good value for your money that you get? This is the tough part at the end for value investors.
Yeah. Makes sense.
Yeah. Okay.
So you're going just as deep as possible.
We have one reason also why it takes so long for us is if I find a company which I like, Tobias has about 2 weeks time to crash my thesis. So he can sit down, he can read everything he needs, and then he can find ways. And most of the time, he then has really some stupid questions which I'm not able to answer. So I need another 2 weeks to find out these questions.
So you're challenging each other?
Yes.
Maybe that's good that you're living so far from each other.
It definitely is.
Because it makes total sense. Everyone gets an estimate time to challenge. Challenge the theory around it.
Right. And just if we both agree that it's a good idea, then we buy. And that's why we just bought one company last year.
Basically, it makes total sense because there is just two of you for this, let's say, one position per year or whatever. And when you have a huge fund manager, you have a lot of people in portfolio management, and therefore it makes sense that it's so deep. And
then what we do at the end is basically we find out if it's suitable for our wood manufacturing company, for our pride portfolio, and then we duplicate it for our clients as well. So that's what we're doing.
So you have clients.
Correct.
Right. That was one of my questions, because on one hand you're managing the money of the wood company, right? And on the other hand you said you were advisors. So how that works?
Correct. Basically, when we find a company, we decide if we buy it for a company. As we have such large cap companies, we can do it legally, because otherwise it would be a problem, obviously. If we buy a 1 million market cap company, we could raise the prices with our clients and then sell it with our... So that's also a reason why we do it with such big positions above 10 billion, because unfortunately we cannot move the needle. And correct, then we have the clients, and with them, so when we make a stupid decision for our clients, they can at least be sure that we have it in our portfolio as well.
Right.
Maybe what we spoke about before the podcast, that we a bit compared the Slovakian market with the Austrian market, and can you maybe tell us?
Or let's cover it, Eastern European versus Western European markets, because that's the major difference.
Yeah. So can you maybe tell us what, or I would start like this, that here in Slovakia, for example, if one wants to become a financial advisor, we have to complete some exams and so on. But it's let's say free here in Slovakia, and not hard to get into the market.
It's not free, but it's very cheap.
Yes, let's put it that way. It's very cheap. And can you maybe tell how it is in Austria, because it's way more different than here, I would say.
I will give some details to that, because the conversation we had before was about how many advisors are in Slovakia, and there is a lot of advisors on the size of the market in comparison with Austrian market, and then we got into how much does it cost actually to be an advisor in each country, and now we're here.
Correct. So we had the feeling sometimes that, I mean, there are some insurance so people that sell insurances and life insurances and stuff like that. But we think, and we sometimes we feel that there is a gap, because I'm getting 30 now, and I guess there is a gap of about 15 years where there are no real and financial advisors who are almost no, they're just a few who are doing a really, really good job. And the reason for that is obviously, if you want to make your license, it costs, and I can't remember, we did it in 2018, and I think it costs about, I would guess now 2,500 per person, and then you have a lot of regulations which make it extremely expensive also to run a financial advisor company, or extremely expensive, not, but you need to show some efforts. Thank you for that.
And there's also those tests that you need to.
But let me get one thing clear. We categorize types of advisors in Slovakia. We have one. First type is the one you mentioned in insurance. So when you sell just insurance and you are, I don't know, under, let's say, Allianz or Unica or whatever, and you sell only insurance products of this company. Then you have independent financial advisors, which are a part, like, for example, in Austria, you also have OVB, for example, that kind of advisors. And then we have a third category. It's also an financial advisor. I don't know how to say it correctly, to categorize it, but those are advisors who are charging the client, let's say, a consultation, and then they advise a certain plan. And how is it?
And for them, we don't have so many actually.
Yeah.
Because it's heavily regulated. But I mean, everyone is worrying about the regulation. In all honesty, what we hear from many clients we have, and also some family members they have, there was really a lot of frauds going on in Austria. Actually,
like everywhere.
Yeah, like everywhere. And I think, I mean, it's still tough to say to mention if you meet someone in a bar, or I don't know, and you mention that you're a financial advisor, they're still not really happy, and they don't think
there's a stigma.
There's a stigma. It's not the best reputation you have, right?
I guess it's the same everywhere, because the commission you get for life insurance, there were a lot of companies who actually did a lot of frauds because of this.
Correct. Yeah.
So,
and also I think it's good that people are really cautious now, because
they should be. I agree with that.
But so I always, when I'm meeting someone new, I'm always saying, like, I have a mathematics company. That's like...
You should say, I'm just wandering the streets of Vienna.
So if you need a tour,
buy a helmet, of
I'm
course.
going to try next time.
My question is, I don't know if you know a lot about our markets, but I kind of can compare. Let's talk about financial literacy, because that's what's very interesting. You mentioned that financial literacy or education is very low in Austria, which is, I don't know where Slovakia should be then if Austria is low. And I see that people are doing much better efforts and decisions, and I don't know how it is possible. So try to tell me from your perspective. Let's sum up the Austrian market in general,
so
if you can, of course.
I think actually that the Austrian market is, I mean, there's a long history that that people are thinking about stocks and stuff like that, but they burned themselves also quite often. So there are many people who also don't like stocks and things like that. But I guess that our big banks, I mean, like, and you have them here as well, like Raiffeisen or Sparkasse, they did quite an okay job, I would say, in terms of getting people to funds to like not something crazy, no scamming things, and that's where people, I think, got some level of trust, I would say.
Because in Slovakia we are criticizing banks a lot of times, because of mostly high fees. That's one thing, and another thing is that bankers are not well educated. So they're selling something. For example, I will give you one example. I was in a bank, and the next table was a client asking about investing, and the banker told him that, yeah, we got a water fund. And after he left, because he didn't make any sale, I asked, what is for God's sake water fund? And it was a ESG fund investing in some kind of water stuff, right? But he didn't know anything about funds at all, about investing at all. Then that's the main problem of banks in Slovakia.
I totally agree, and I guess it's not much different in Austria, but at least the products they are having at the end, or where the banks are giving the direction.
Yeah.
I mean, I agree they could have, with an ETF, they could probably have 6% per year or 7%, or
They could.
they could,
Yeah.
but because of fees they have only 3 or 4% in the banks.
Actually, there is a lot of solutions in banks that are really good. The problem is the execution.
Yeah, actually, I think in Austria, like when I talk with bankers and those people, I think they are quite good, right? Because like we have all this like those banks that are like really old, and so they really look for their reputation.
Yeah.
It's
Sort of
more
cautious.
Yeah.
Yeah.
But they are quite good. It's like, I mean, they could be better, of course, but it's mostly those independent advisors that
But
are
you
like
need
kind
to
of
feed
scamming.
the whole system. The huge bank, you need
Correct.
to, of course, you need to pay everyone.
Yeah.
So
I mean,
you cannot have cheap products
Yeah.
unless you're a small company.
Yeah.
but
And
that's
it's also
our advantage, right?
Sure.
Because if there would be cheap fees, then it would be difficult for us to get customers. So it's kind of an advantage to show the people, because they think that like what we just said.
Yeah.
If you have an ETF with 6% per year, or you have a fund with, let's say, 4% after fees, they think they that's actually what we also meant with the Verhältnismäßigkeit, with the
relativity, no?
with the relativity, yeah, or with the
Kinda.
proportionality,
Yeah.
right? Because they think it's just a little bit less. But if you invest, as we are young and we have like 30, 40, 50 years of investing, what difference it makes between 4 and 6%?
Yeah, it's like I mean, when you have like those 2% that you have to pay every, or like 3 or whatever,
He wanted an actual number.
Yeah,
Because you have a mathematical company.
Yeah, let's,
how many years?
let's say for if you invest 10,000, then you have
2%, 20 years, go.
2%, 20 years is like,
From
I
4
don't know,
to 6.
150
at 6%.
at 2% with 20 years.
Yeah.
At 6%, it's like 320, something like that. I don't know.
Okay.
From
Because with
100.
7.2%,
Yeah.
it's like 400. So with 1% less, 20 years, it's like 20% less than 400. So you have like 20% is 80, so 300.
So
roughly.
put just those two numbers in comparison, 4 and 6%. What's the huge difference in
I guess we can sum it up and say it's a huge difference.
It's a huge. I mean, it's quite easy to calculate. Like you can just say that like the 4% or the 2%, 4% is like 2% less than 6. And if you have that 20 years, so just to visualize it, because then it makes more sense. It's like a cake, for example, because you don't have this 6% every year. It's like a cake that is growing, going smaller, growing, whatever, and it's like doing like that. And if you cut out 2% every year, for example, then you have a 2% piece that you cut out of that cake. Whatever, how big it is, you cut out those. And then you can see, for example, in 30 years, if you have a little bit over 2% fee, you have only half of the cake.
Yeah.
This was perfect example. Yeah.
And also mathematically, it's easiest to calculate.
And that's the crazy 2% of difference gives the whole half cake to the bank, to the advisor.
No matter how big it is.
You know what's the problem here? That we are always talking, and I completely agree with you, definitely, don't get me wrong, but we are always talking about people who are rational. Who are rational, and therefore they don't need any management of their portfolios. But there is a lot of people who will pull out in the financial crisis, who will pull out in a dot-com bubble, who pulled out in COVID crisis. And that's where they lose more than the 2% they would give someone.
Totally agree.
And that's always the fight between, look, I am a cheap ETF, and why do you need anyone when you can buy just this cheap ETF, MSCI World, whatever? And here, on the other hand, we have this huge bank who has this fund and has a lot of fees and stuff like that, but manage the money well, so the client or the retail investor or whoever it is okay in all the times, and has lower drawdowns and stuff like that.
I guess this is exactly what I wanted to say before, that the banks in Austria made a really good job with that.
Yeah.
So although they had higher costs, the people are still buying funds, and people in general. I mean, we have a quite a good pension system still in Austria, which is still working. So people do not need to finance their pension, like it is in the US, for example, where people need to save money for retirement.
Yeah, they need their 401k.
Yeah,
or here in Slovakia, we have to.
You have to?
No, that's a different system, because in the US, if you don't have a 401k, you have no money. We have, let's say,
something
crumbs from the bread at the end of the day, but we have at least the crumbs. In the US, they don't have even the crumbs; they lost them.
Okay.
Yeah, the pension system is great, but still, what you said and is really interesting and should be a very good message for our listeners is that you have a very long time period of investing and you have a history. That's you know what I mean. It's you invest even with a very low performing whatever it is, but still low performing for 40, 50, 60 years sometimes. Sometimes maybe more, I don't know. And we are investing 10, 15, and that's what we call long-term investing, right?
Yeah. I mean, it is also kind of long if you wait 10, 15 years. Or let's say if I say now 30 years, it sounds easy, again, as you said before, but if there is a crisis, you need to be in your head. You need to be prepared for these things.
Yeah, for lost decade, for example, or
like.
And this is also, I think, what just banks in Austria, because I didn't want to seem to bash them before. They get that also really good. I think that they make the people kind of long-term thinking.
Yeah.
So we have some bankers that we talk to regularly, and they are like amazing.
That's true. There are a lot of people. That's why I kind of agree with the whole being more strict in licensing of advisors and bankers, because who goes through with it is actually a good, very well-educated financial advisor, not just anyone. And here it's like anyone can be a financial advisor, and then it's up to him or her to educate themselves at the best.
Yeah, so simply said, what is missing here compared to Austria is, for example, very good bankers that, as you said, you consider bankers as a professionals. What we can't say in most of the cases.
Yeah.
Do bankers earn a lot of money in Austria? Like good money?
That's a good question, which I should have checked to get my market value. But I can't actually really answer it. Like I don't know. I mean, as you said, like Raiffeisen, for example, it's actually a company with which we are in our wood manufacturing company are working together, not with our portfolios, because therefore we have an online solutions to keep fees low. But I guess there are a lot of jobs. They're always looking for people, and I guess it's you will do well in Austria if you work for a bank.
As you said, it's really important so that they have like this long-term vision, and then it's like they don't fall, like, because a zero doesn't multiply.
Yeah, they have to understand the whole industry.
Yeah,
actually.
Yeah, they don't need alpha, so like real alpha.
So maybe can you tell us something about your fee structure? How you work with fees?
So we have
effective.
So we have actually, as we are managing our wood manufacturing company, or the financial, or we're looking for ideas, because the manager is still our dad, who is like in charge of everything, and we are just preparing the ideas for it. We were also thinking of, okay, should we just buy an ETF? I mean, also Warren Buffett says that basically you should just go for an S&P 500 ETF. And as we do think that we'll have a better return than the average ETF, we think that we say if an ETF is getting 6% in return, I mean, it could be 7, it could be 8, maybe in good years like the last years it was also higher. We think we put 6% on a line, and then we said we want to earn a quarter of the excess. So if we have let's say a customer who is making 8% per year with us, we get from the 2% which are over the 6%, we get a quarter. So at the end we get a 0.5%, and the customer gets 7.5%. If we make less than the 6%, we don't get anything. And this is actually how we try to align it. I mean, it's stolen from Buffett's partnership. This fee structure, he did it in his when he made his partnership in.
It's like we don't get anything when we are bad, but when we are really good, then we get ridiculous amounts of money, which also should
Makes
be
sense.
like that way.
Well, well, that's your motivation.
Correct. And I mean, one could say that we then would risk a lot and go in like high volatile stocks and have like a roulette, black or red. If we win, we get it, and if we don't win, whatever, it's the customer's money. But that's the reason we invest our own money in the same idea. So it should not be actually that we have a performance of, let's say, 3% per year, which is now better when you put it in your savings account. You have more, or you have 3%, and then we don't feel we deserve to drive a Ferrari through our home village then.
Yeah. Makes completely sense.
Yeah, this is beautiful.
A lot of scams are actually influenced by this model, but they are doing exactly what you told me you're not doing, and that's investing in very high volatile and crazy stuff, and that's when they get to cryptos and stuff like that.
Correct.
What do you think about cryptos actually? Because you're kind of a generation of cryptos.
I mean, for us, it's super simple.
Super simple.
Because we need to value the things we buy. And with crypto, we're lagging. I mean, there are some people who tell you how to value these things, but I think it's easier.
Don't trust them.
I think it's easier to value, value a company, which I said before, who has, for example, more cash on their balance sheet.
Well, creates a value. That's so easy.
And you have people who work for you then, right? So I mean,
so what's the value of this?
This one, I guess, as you said before, you bought it from AliExpress.
Yeah.
That's why I wouldn't buy it from you.
I wouldn't sell it. It's not for sale.
Maybe one point in time, this will be worth more than a Bitcoin.
Maybe. So I have to pull out.
So Pharaoh made alternative investment in plastic Bitcoin or whatever it is.
Dude, it's not plastic.
Oh, okay, so it's a real coin.
It's pure gold.
It's a real coin. Yeah.
Okay.
I believe it.
Yeah. No, that's why.
But don't open it.
That's why we can't. I mean, there are so many things. I'm not sure which because this is a kind of an valuation approach we have. We need for every asset we have, we need to find a return which we need to get. So, for example, if I would buy a company in Austria, let's say, which is highly regarded and everybody knows about, I maybe if I get now 3% at the savings account, I maybe am happy with about 7-8%. Of returns I get. This could be in dividends, this could be in stock repurchases, which we prefer due to tax reasons, because at the end it's exactly the same if it's a dividend or a buyback, but whatever. But if I'm going to buy now a stock in China, let's say, where we don't know, or in Taiwan even, where we don't know how this situation is unfolding, I need at least 15%. And this is actually a thing with Bitcoin. I'm not sure how much percentage of would you need, Pharaoh? If you invest in Bitcoin, what is
1,000,000% in 2 days. And no, I'm fine with what Robert Kiyosaki is saying every year. Well, this year is different because the last 5 years he was saying that by the end of the year it has 100,000 value. Now he's telling, well, I made a screenshot of it. Yeah, 100K by June this year, and then 300K by the end of 2024.
Cool. So it's from today's price, it's about almost a 5-fold.
Yeah.
So I should sell my my Volkswagen Golf, and
buy Bitcoin.
Go for Bitcoin.
Definitely.
If it's so easy.
All in.
But this is actually what all scams are. So I won't say now that Bitcoin is a scam, obviously. But this
a lot of people do actually say it's a scam because there is no value. There is nothing behind. No one knows who is Satoshi Nakamoto.
Correct.
Our problem is just that we don't know also enough about Bitcoin to make such statements. But like Charlie Munger said, like it's rat poison. And so I don't want to buy something that Charlie Munger said is rat poison.
From your point of view, actually, I fully understand it because you cannot do a very deep dive.
Yeah, it's like I thought about it and it's just...
It's like a baby pool where you can just put in your toes and that's it.
And investing, the thing I really enjoy about investing is that you are able to say no to things.
Yeah.
Right. We can look for the things we invest in for ourselves. We can decide. That's why we only bought one stock last year, because we were only on one company. We were sure, more or less. I mean, there is risk awarded, but it was actually what I said before, a stock where I don't put real numbers in, but a stock where we need, due to maybe also China risk, where we need, I would say now 12-13%, and for this stock we think when we calculate that we get 16%.
Yeah,
and this is something I can't do with many things.
If the risk doesn't manifest, we get 16%. So because there's always like risk is like in the end manifesting, like mathematically, and so what you are left with is the interest and the alpha. So our return is obviously way lower.
Correct.
What's your long-term goal? What do you want to, create? What's your potential legacy?
So, I mean, I really do enjoy my job right now. We have not extremely a lot of money under management yet, but I'm able to, as I said before, to look for companies, to learn about different sectors and learn about things. It's a job I really do enjoy. But obviously, if we are not able to be better than the average in the next 5 years, we need to find another job.
Okay.
So, because we don't get any fees then, right? And if we don't get any fees, our family office and our 3 brothers, besides Toby and me, also decide that it's better to buy an ETF than for the family company. Mm-hmm. And therefore then I need to find another profession. And this actually the long-term goal is this thing is still successful, and then it should turn out the success would turn out for himself, I guess.
Also, maybe I'm quoting Charlie Munger way too often today, but because he passed away like so shortly, and so we are really fondly of him. But he once said that the best way to get something is to deserve it. And so we don't really think ourselves in terms of goals that we want to reach or something, but we want just to give the most value that we can give, and then we will look what we deserve.
Yeah.
But obviously grow the company, make customers happy, and get to a certain asset under management.
Well, that comes with the deserving, of course.
Correct.
Yeah.
That's why it's so difficult.
Just provide value.
Yeah. I mean, and also it's also like a value investing mindset. But if you have a really an exact goal, let's say my goal would be in 5 years, I don't know, 50 million under management. Mm-hmm. It's just a random number now. maybe there are, and I would have this goal, and I really try everything to reach this goal. Maybe I'll do some shortcuts which are not benefiting me in the long run.
Yeah.
So we're so not just with our investments focused on the long run, but also with our business. So we want to become our business successful in 30 years. Not tomorrow. We don't need to buy a Porsche tomorrow. We don't need to have spend our vacations in Dubai in
Who
summer.
wants to be in Dubai?
Sorry?
Who wants to be in Dubai?
Yeah, as I'm from the mountainside in Austria, you can imagine I'm not. I prefer Italy way more.
Me too, definitely.
But yeah, as you said, so you put it well with the deserving part.
Yeah, it's very nice, and it basically comes with your whole mindset. When you're value investors, you have to always look for the long term and not looking for shortcuts. Even though sometimes shortcuts look very attractive and are cool and whatever, but if you keep your mindset and you're stable in what you do, you will always reach it.
Correct.
Stability.
Correct.
Yeah,
correct.
yeah.
And this is actually, you put it so well, Pharaoh, because I think many people don't. They need the success tomorrow. And
everyone wants the success tomorrow.
Yeah.
That's why we have such a crypto hype. That's why there was a .com bubble.
Correct. I totally agree.
I a lot of times I compare what's happening now with cryptos to the .com bubble because it was very similar. Everything that was called .com was suddenly a big hit and a huge hype, and it will grow tomorrow thousands of %. And that's why I was trying to compare the Austrian market, where you see as a long-term investing 30, 40, 50 years, and we see as a long-term investments 10 or 15 years and 20 max.
But also Austrians see there is also 10 to 15 years when we speak with customers. They sometimes say, I'm 60 or 70, I don't need 30 years of horizon. But we see it for ourselves, and I think it's the for us it is. Maybe there are some people who have another approach which is also working. Also, if you're building a company, if the companies we invest in, obviously we need them to be also successful in the next years to make the calculations of Tobias work with the return we are achieving. But for us, we feel the most comfortable when we say, okay, you just said you're turning 25 now, but I guess in 10 years, which is 3,650 days, we are able to live very comfortable from our job. It's a cool goal, actually.
Yeah.
I mean, I would say that I really like this humbleness. You know, how humbleness speaks from you. It's really not common in the world of finance, where everybody are wolves. You know,
it is common in the intelligent part of the industry.
This is where this is what I wanted to point. You know what Pharaoh said.
So for us, actually, it is amazing to go to Omaha to Berkshire Hathaway to the annual meeting. 40,000 people listening to. I mean, last year listening to a 99-year-old and a 94-year-old, I think. 93?
I don't know. We should know.
Sorry, Warren, for making you older than you are. And all the people you meet there, you know, you're sitting in a row with someone who is managing $2, $3, $4 billion, and they're sitting there dressed extremely casual, and just being so extremely humble and so nice. It's actually where we decided this is the job, and this is the job we want to work in, and also the field we want to research on. Yeah,
because usually people who manage that kind of money don't need to flex with their Lambos on Instagram or with their yachts or whatever. They just need to manage the money and live a very humble life with nothing to worry about.
Actually, maybe a little story to that. We had a customer where we were managing the money of the family, and I was driving with my Volkswagen Golf, you know, I mean, it's a pretty car, and it was.
He's flexing with his golf.
Yes, I'm flexing.
You said he's humble.
I'm flexing with my golf. But then their 10-year-old child was coming and were asking the mother, "Are you sure they're able to do it if they come with this car?" And I was basically saying, I think it's better to have 100,000 euros in my portfolio and drive a $10,000 car than the other way around. And
yeah, that's true.
Because my return that I'm achieving, thankfully, pays my car quite quickly with this.
Everyone wants to flex, you know. That's this era's problem, that everyone needs to show how much do. Basically, that's the same model as everyone is from up and down, from top to the ground, dressed in Gucci and Louis Vuitton and stuff like that. And then you look at Warren Buffett or Bill Gates or even Jeff Bezos, which he's flexing a lot, but not with this kind of stuff.
Totally agree.
Yeah,
totally
so
agree.
that's how you can see the real value.
I totally agree.
Yeah. I almost forgot to ask, on your losers, if you ever did some mistakes while stock picking.
Horrible.
All right, because that's really worth mentioning. You don't need to name anything, but we need to say it, because then it would look like we are only talking about
just
success.
One company that we lost money on, I think.
Because we are holding it so long, you know.
Yeah.
Right.
And we have so few companies, so it's just one, but we lost a lot with it.
Okay.
Okay, so what we did maybe wrongly there was, like, from also a mathematical perspective, that we simply overpaid, but we overpaid because there was like so much that we did not anticipate. There was also like lots and lots and lots of bad luck, because as you know, China, it was like, especially we bought right before all this overhaul started.
Okay.
I don't think of it like mostly as a mistake, more as bad luck and that stuff. But like what we really did wrong is that we had those calculations back then, and you always have to incorporate the risk in your cost of capital when you think about that.
That's what I meant with you need now 15% when you invest in China.
Yeah.
We thought that 10% are enough.
Yeah.
And the problem is what we had is that first we had the risk component too low, so our cost of capital was probably a bit too low that we had. And secondly, for me, way more importantly, we totally got the sensitivity wrong, because different companies have different sensitivities to, for example, I don't know, risk, interest rates, which is like mathematically quite the same in the discounting. And the problem is, for example, when you use Excel, it always seems so easy. You just put in your values and then you get your number.
And the discounted cash flow analysis, for example.
Yeah, and this is also why I think Buffett says you shouldn't use an Excel, because the mathematical part, like the calculation, is by far the easiest. So you should be able to do it probably maybe not in your head, but on a paper. It would be better to be able to do it on the head, because if you're not able to do that, then you don't feel the sensitivities. Because if you are not able to calculate very quickly and say, okay, let's assume the discount rate is like that, or is it that, how much does it change? And the problem sometimes with let's say you have a very high quality company, which has like a high multiple, because the risk is so low. Let's say like the structural the idiosyncratic risk of the company is so low. And let's say that company is in a country where first we have like a country risk premium, like a delta risk to USA, for example, of like 1%, 2%, like very low. Then it really doesn't move the needle so much. But like those companies that are very high quality, have very low discount rates, if the risk increases in the country, they get destroyed.
Yeah. For example, if you have a Chinese stock and you have, as we said, you need a return of, let's say, 10%, and it's priced for a return of 10%.
Yeah.
But then the risk increases to, let's say, 20% to make things easier. You could say theoretically that the price must halve.
Yeah.
You lose 50%.
Yeah.
And this is, for example, also like even more extreme. Sometimes companies have a lot of cash. So if you value the cash as cash, then you have a certain number, right? It's like the cash is worth what it is. It should be, right? But sometimes you have companies that don't give the cash out for whatever reason, and the problem.
Maybe they can't due to legal reasons or
whatever. And
they're so big.
And the problem is, like, cash is worth cash because it has like an interest rate that you get on it, and you have a discount rate, which is, because there's no risk, the discount rate. So it's the same. So it's worth what it is. So you have like a discount rate of 3% or 4% or whatever. And the problem now is, if that cash money is in a country that suddenly you feel you have like a 50% of not getting the money anymore, then you have to divide it by 50. By two.
Yeah.
So, but like by 0.50. And the problem is, if that risk is elevated every year, then you actually, let's say the risk is 5% a year. So if you have like many companies or like many, then you lose 5 a year with those cash. And you say that the risk persists forever. And you don't have it in the price in the currency and whatever, then actually you're losing money every year. And so in that really strong sense, the cash could be worth nothing if discounted forever. I mean, that's like ludicrous, but that's what we really got wrong with China.
Yeah.
So since then you're not investing in China?
Sure, of course, because now the price has changed.
Yeah. And
the adjusted risk now. And
I always see China as a very unstable economy because you don't know anything what's going on inside.
Correct, but
that's what we like, because I mean, it fell so much, but we think the risk is really high, but lower than anticipated.
Yeah.
Because there's like a small door in a cinema, and everybody wants to go out at this door.
Yeah.
And this makes the price drop, right? I mean, Monish Pabrai, also a value investor, put it so correctly that he said, investing is like sitting in a theater, and the theater, everyone has a seat, and the theater starts burning. But the thing is, you always need to find someone who you give your ticket, because you can only leave your seat if you find someone that you give your ticket. Yeah. And the thing is, how low do you sell it? So you need to know how big is the fire. How does it get now under your ass?
If it's worth it.
If it's worth it, yeah. And this is actually, and if I would say to have like my perfect portfolio, I would love to have 20 companies in my portfolio, or 10 companies, where there's every time a little bit of a fire, a small fire, which I can have a look. And I mean, sometimes it burns down on some positions, and on some it turns out good. But this is the thing we meant with, if you need a return of 15%, including the risk, and you calculate a theoretical return of, let's say, 20%, and you have 20 positions of that in your company, because this is an important thing of position sizing. Obviously, now with China, you need to keep your portfolio, your position really small.
That is the second mistake that we did. We did not really Kelly optimize. We did like the Kelly formula. We did optimize for that, but we assumed that the risk is being stationary. Yeah. And now when it became way bigger, the risk, we saw, we have too much in it.
Yeah.
Oh, you had to check. Yeah.
But thankfully, it got down anyway. Okay. So the problem solved itself. But it was good for our customers to learn that investing is, you need to be cautious in investing, and although you think it's a good idea, you need to position the size correctly, and also it can't go up all the time. You have some losers, you have some winners. What counts is that at the end of the day, your portfolio is doing well.
Nice. Guys, I guess you are ahead of your time. That's my personal opinion because there is not. Do you have any competition that is maybe similar to you? Not doing the same kind of business, of course there is, but similar model that you are pursuing.
I mean, the fee structure, Tobias, in Austria, we are eager to find someone who is doing that.
Mm-hmm.
Also in Slovakia, please write us an email.
We have, but usually there are potential scams, and the National Bank of Slovakia is warning a lot of times on these kind of companies, because the fee structure is very similar, but on very risky things and not transparent. They are just doing a lot of marketing, flexing a lot of cars and stuff like it, not humble at all. So it's a completely different model in this kind of way, but the fee structure is very similar. It's also, we have no fees, but it's motivational. If we grow, we get success fee. That's, well, and they're always growing, of course, obviously. They have no losers at all. They have only super cool projects in different kind of areas. So yeah, this is a very big problem that we are having in Slovakia and Czech Republic as well. And as we talked before, you don't have as much scams like this because even though you say you have a very low financial education in Austria, it's nothing compared to us. We need to really work on that a lot. So that's why we do this podcast, for example, and stuff like that. Yeah.
But you have what I heard and what I would like to keep the Austrian politics also in is your capital gains. If you keep a stock for 1 year, you have no capital gains taxes, right?
Yeah.
It is actually something which is a little bit longer term oriented. I think it could be also a good idea for Austria, because we have 27.5%.
Yeah, it's crazy
on everything.
Yeah, we have a very huge gap of taxation in mutual funds, ETFs, and stocks, but still there are some advantages, which are, I always think it's cool because that should motivate people to invest, and every country should do it. And after, I don't know, 80% of the nation is investing, then you can start taxing, because everyone is already used to investing fine. That should be the model.
Correct, totally agree.
Yeah. But yeah, everyone has advantages, disadvantages. There is a lot.
If it's not secret, can you tell us how do you perform historically?
It's super tough because we have separated accounts. Every customer has his own performance, and then it's the question: is it our wood manufacturing company? Is it our family business when we started in 2012 with our brothers and our parents, or is it our financial? But I would say in general, it is. We were doing quite well with the quota over 6%. And
I mean, we could say for the wood manufacturing, our personal accounts. I mean, that was mostly also our dad. And there was also Microsoft in there, so it was quite good. But we had since 2012, we had 19 to 20% annualized. But this was a really good era.
And for the last 4 years for our accounts, we had I think it's around 17% per year.
But it's it was way too good. That is not possible.
Obviously, including our Chinese lovely company. But what I really like is how we also did, for example, in 2022 when stocks were going down a lot. This was also the reason I mentioned before. This was the time we bought 3 companies where made the record. Let's say, because, and this was also the reason why we bought the Chinese company. We started in 2020, and unfortunately, it took us quite a long time to get everything structured with our clients. So we missed the COVID low, and then we had only one position, a big one, a company we already talked of, where we have been in Omaha, and this was the only company for our clients.
Berkshire Hathaway.
Yes, and that's why we felt that we need to do something for our clients.
Oh, okay.
And then that's why we bought in 2021, when it was already quite expensive. We didn't find anything to buy, because everything was getting more expensive.
Yeah.
So for us, it was a time to.
From my point of view, it was totally irrational that everyone was, well, gaining value.
Yes.
Without any reason, actually.
And everyone was
funny.
outperforming us.
Right.
We were the total losers actually in this time, because all our friends and who were investing in the Robin Hood kind of apps in Austria, everyone was performing better than we were.
Is Robin Hood in Austria?
No, but like kind of this things. And I don't want to mention a bad stockbroker, but they were all doing better than we did. But thankfully, for in our case in 2022, we had then the opportunity to buy amazing companies for a great price, which we bought, in my opinion, undervalued.
Yeah.
Okay. I mean, we discussed a lot.
Yeah, and I want to thank you for coming. It was really, really cool, and I hope a lot of our listeners understand English, and if not, I will try to translate it. But nevertheless, thank you very much, guys. It was an honor and a pleasure, and I hope we can do a follow-up maybe in 2 or 3 years where you will manage the 50 million or maybe more, who knows. But still, all the best to you guys. You are really, really something special, I have to say, and the humbleness and your approach is in a way old-fashioned and something that is long-term.
Yeah.
It was perfect. Thank you very much. We wish you all the best.
Thanks.
Thank you.
A lot.
Guys, see you soon. Bye.